Hi guys, so today I am talking about financial freedom and in particular how the UK state pension can help with that. Now when we say financial freedom, we basically mean the ability to, if you choose, not work and know that you've built up enough assets, you have enough wealth, enough income in retirement to live on for the rest of your life. So if you choose not to work, you don't have to. Now the reason the UK state pension is quite important when it comes to that, or can really contribute to that in a significant way, is that the way the UK state pension works, you get a guaranteed income for the rest of your life from state pension age 67. So it goes a long way towards helping you achieve that financial freedom. So what is the UK state pension? How does it work? And how can you obtain it? So when people live and work in the UK, typically employees paid tax and national insurance through the PAYE system. Or if someone is self-employed, they would pay national insurance through their self-employment self-assessment tax return. In any given year, when you pay national insurance in the UK, provided you pay over a certain threshold, you get what we call a UK state pension tax credit. Now, you need 10 of those tax credits, state pension credits, to be eligible for a state pension, the minimum amount. You need 35 to be eligible for the maximum amount. That minimum amount for 10 years is currently around £63 per week when you hit age 67, which is the state pension retirement age. For 35 years, that value currently is £221 per week, but as of April 2025, that will increase to £230 per week due to something called the triple lock, which is essentially, it means that the amount that the state pension pays you every single year will increase by the higher of 2.5% average wage growth or average inflation in the UK. So it's much more beneficial than most investments or most sort of annuities, which typically increase just by one of those metrics, i.e. inflation or wage growth maybe. In any years where those two metrics are below 2.5%, you still get an increase. So the UK state pension is super beneficial from how it's going to grow over the years. When it comes to people who don't have the state pension credits because they leave the country or because they're not working and they're not paying national insurance, you have the ability to make what we call voluntary contributions to still obtain the credit for those years that you missed. Now, those voluntary contributions can be made on a Class 2 or a Class 3 basis. On the Class 2 basis, it's the lower amount. It costs typically around £175 to get the credit for each year. On a Class 3 basis, it's more expensive at around £850 to £920 in the current year to get the credit for each year. Now, typically to be eligible for Class 2, you need to have lived and worked in the UK for at least 3 years paying national insurance, and you need to have, when you left the UK, gone straight into work essentially and been working the whole time. That way you would be eligible to pay Class 2. Now, even if you are only eligible to pay Class 3, which is the higher one, at say £920, it's still beneficial and people should still do it. I hear so frequently, well, why should I pay £920 to get, say, 15 years that I've missed? I'm going to end up paying £14,000 to basically increase my pension, which is only ever going to be at the most £230 per week. But the way you need to look at it is, when you have a pension, a private pension, you have the ability to either take that sum, that lump sum of money, and have the investment risk of stocks and funds going up and down, or you have the ability to buy something called an annuity. So let's say you've built up £100,000 in your private pension fund and you buy an annuity towards your retirement age. That annuity may pay, say, 5-6%, which is quite typical for an annuity. So that means you pay £100,000. For that £100,000, you're going to get 5 or 6% per year for the rest of your life, i.e. £5,000 or £6,000 per year for the rest of your life. And that is a typical annuity value. When it comes to the UK state pension, for each year of additional contribution that you pay until you get to 35 years, it increases your weekly amount by around £6.30 per week. So that's over £350 there or thereabouts per year. Now, if you're paying Class 3, which is £920, that's an annuity rate of 35%. It's unheard of. You will not get an annuity for 35% annuity anywhere. And if you're paying Class 2, the lower one at say £180, £175, £180 for the credit, that annuity rate is in excess of 180%, which is crazy. It's staggering. So everyone, regardless of whether it's class 2 or class 3, should absolutely make the contributions, make the voluntary contributions, and get up to the full 35 years if you can. Now, when it comes to making backdated contributions, you can only currently backdate as far back as 2006. So any gaps that you have from 2006 onwards, you can currently make a backdated voluntary contribution. But you need to be quick with this, because as of April 2025, you're going to lose the ability to pay a lot of those years, because they're going to change it so that you can only backdate the previous 6 tax years. So from 2006 up to maybe 2017-18, you're going to lose the ability to pay for. So my final point on this is, if you are eligible to make voluntary contributions to the UK state pension and you don't yet have 35 years worth of contributions, absolutely you should look into doing it, and it will help you on your way to financial freedom.